Okay, we're going to go ahead and get started now. Again, this is Adam Goldstein from the Federal Home Loan Bank. Good morning and welcome to today's webinar. We thank you for joining us to hear from Professor Tom Vartanian, who will discuss his new book, 200 Years of American Financial Panic, Crashes, Recessions, Depressions, and the Technology That Will Change It All. He'll synthesize and give us the history and causes for the past financial crisis. Actually, Tom had spoke to our board in May of this year, and it was very well received, and we're welcome and thrilled that he'll join us today. He speaks to us and our board and our management committee very regularly and is very helpful in the creation of our long-term strategic plans. He's been a great partner of ours. We also want to remind you that our next session, Taking Stock of the Current Economic Expansion, which will be presented by our own Brian Jones, financial economist, Thursday, June 24th. He'll discuss the national and local economies through the rest of 2021 and beyond. Invitations for that will go out at the end of the week. After that session, like we did last summer, we're going to take a little bit of a hiatus from the webinar series. And then when things continue to open up, and we're going to rebalance our educational programs and keep you apprised if we'll do more of these webinars as we have for the last 14, 15 months, or be coming to visit you personally, which we're very much looking forward to doing. Just a couple highlights from the Home Loan Bank side. We have extended at member request the advanced special that we were running on offering symmetrical prepayment features at no additional charge through the end of June. So that saves you 2 basis points. Also on May 28th, we announced that our board approved a 4.75% dividend for the first quarter of 2021, with about $62 million in cash dividends distributed to our members on June 1st. So hopefully you enjoyed that dividend income from the bank, and of course we want to always remind you that that's worth about 18 basis points on the economic value of your advances with us. So please keep that in mind when evaluating your wholesale funding needs. On May 3rd, our 2021 Homebuyer Dream Program round opened with about $16 million in available grants made for supporting home ownership opportunities. That round will remain open through November 30th. And finally, as we continue to onboard our members on the MAP program, Mortgage Asset Program, we encourage you to contact your relationship manager for a one-on-one session virtually or in your shop to talk about the specifics of the program and how that works versus the Fannie and Freddie programs and the whole value proposition. Okay, so just 2 quick details before we get to today's webinar. If you have any questions, please submit them at any time through the question box, and we will answer them at the end with a Q&A session. And when the session concludes, you'll receive a survey where we ask you to talk about your interest, your area of interest for future educational programs, and also your interest in receiving a complimentary copy of Professor Vartanian's book. We ask that you complete that survey. Very, very important to us, so we thank you for that. With that, I'm going to turn it over to Tom Citino, Vice President, Director of Member Relations, to introduce Tom Vartanian. Tom?
Okay, thank you, Adam. Let me just start. It's really a pleasure to introduce Tom Vartanian. We had met recently. He's a really fascinating individual. He's had a very interesting career in law and the financial services industry. Tom is an author, a financial advisor, and a board mentor currently. He was the former executive director of the program on financial regulation and technology at the George Mason University's Antonin Scalia Law School, where he was also a professor of law. Tom had a 35-year period where he was very involved in the financial services sector, as he is now. He chaired the financial institutions practices at 2 international law firms. So he was an attorney in the financial services sector with 2 firms, Deckert LLP and Fried Frank LLP, and he served with those law firms through 4 financial crises, and I'm sure Tom will be talking a lot about that today. He was involved in many bank failures through his career, 30 out of the 40 largest bank failures in history. So a very interesting career. Prior to that, he served in the Reagan administration as a general counsel to the Federal Home Loan Bank Board and to the FSLIC, where he was really in the middle of everything regarding the S&L crisis. He also served in the Carter administration as a special assistant to chief counsel at the OCC. And then also he's informally advised many presidential administrations on financial services issues, and also worked towards modernizing regulatory practices and also training financial regulators. He's also a very prominent author. Tom has authored more than 400 articles, and he's authored 8 books, including his new book, which Adam just mentioned. And don't forget, if you're interested in receiving a complimentary copy of that book, you have to go into the survey and let us know that. Lastly, Tom's also a frequent lecturer on some of the major media outlets, CNN, Fox News, Bloomberg, Newsmax, and on many radio shows. He's also taught financial services and digital commerce law at Georgetown Law School, George Washington Law School, and also Boston University School of Law. And he's also been a guest lecturer at Harvard Law School. So very interesting and extensive background. We're very interested in it here at the Home Loan Bank, and I hope our members are also interested in what Tom has to say today. So with that, Tom, I'm going to turn it over to you to start the webinar. Appreciate you being here.
Great. Thank you very much, Tom, for that wonderful introduction. It is a tremendous pleasure to be back with the Federal Home Loan Bank of New York. One of my longest and dearest clients, frankly, over the many, many years, and all of the members of the Federal Home Loan Bank of New York, many of whom I know, but of course can't see, because all I can see right now is myself. So I just wish all of you the best, and hopefully the next time we will see each other live and be able to shake hands once again. So I guess what I want to do today is talk about the nexus between financial crisis, regulation, and technology. I think they all come together. And let me just talk a little bit about the book and how it came together. I decided probably when I was general counsel of the Federal Home Loan Bank Board, and we were staring at 4,500 failing SNLs, that the explanation that was being given for the failure of the savings and loan industry didn't mesh with what I was seeing in terms of handling it. As most of you may remember, there was an explanation that it was fraud, negligence, and criminality that caused the demise of the savings and loan business. But the first time I got a briefing by the head of supervision of the Federal Home Loan Bank Board, which is March of 1981, and he explained to me and Chairman Pratt that there were 4,500 institutions and 4,500 were failing, I knew immediately that it couldn't be fraud, negligence, and criminality. You couldn't have 4,500 financial institutions in this country failing all at the same time under the watchful eye of hundreds and thousands, literally, of federal and state regulators. And so what I learned working through that problem and have thought about for a long time since is the fact that government policy was largely responsible for the savings and loan crisis. And it's very easy when you look back in hindsight and take a look at it. In 1966, Congress made savings and loan institutions subject to Regulation Q, which means they couldn't pay more than 5.5% for any deposits that they took. And the reason for that was to try to subsidize home mortgage lending, that if you cap the expense side, the savings and loans would be able to offer low interest 30-year fixed rate mortgages, and they could only issue 30-year fixed rate mortgages. There were no variable rate mortgages at the time, except for, I think, for 5 states throughout the country in 1981. And so when interest rates hit double digits in the Carter administration and finally tapped out at 21% of the Reagan administration, you had institutions that were illiquid because they couldn't pay more than a 5.5% in an environment where Merrill Lynch, Prubase, and Shearson, the main purveyors of money market funds at that time, were paying about 12.5%. So all of the money was moving out of the system. And similarly, you couldn't sell any assets to become liquid because all of your assets were 30-year fixed rate mortgages yielding about 7%. Now, why were they at 7%? They were at 7% because the states piled onto this problem by passing usury laws that kept most of the mortgage lending throughout the country at between 6 and 8% pursuant to state usury laws. Some went up to 12, but most were 6 to 8%. And so you had these institutions that were crushed by an economic vice that nobody had anticipated. And that's important because when you're looking at the at the history of financial crisis, the fact that nobody anticipates a lot of these things has to be taken into consideration when you're making policy. So what I want to talk about is three questions that impact all of us going forward. Number one, what are the causes of financial crisis? And I think we can discern that over the last 200 years. Number two, how can we avoid them in the future? That's the critical question I wanted to answer in my book. And number three, what role does technology play in all of this moving forward? So let's just take a look at some of the things that affected me as I took my experience from the savings and loan crisis and the 2008 crisis and the collapse of banking in the 1980s and oil crisis, and looked at the 200 years through that lens that I had. Over the last 200 years, I guess I finally asked myself the question, were they 200 years of prosperity marked by financial crisis? Or were they 200 years of economic chaos marked by periods of prosperity? And the reason I say that is because when you look at this history and you go back over it again and again, what you realize is between 1819 and 2019, or 2020, we had 10 financial crises. If you add up the years it took to build up to those crises, live through them, and then rebuild after those crises, you're talking about 40% of the years in that 200-year period that is somehow related to a financial crisis in this country. 40%. When you add on wars, you add on massive earthquakes, fires, natural disasters, you're literally talking about 80% of the years in that 200-year period were chaotic and crisis, and many of them leading to financial crisis. And so the question I come back to, and I keep asking myself, is, were those 200 years of economic chaos, or were they 200 years of prosperity marked by some years of economic chaos? And the way you look at that question has something to do with how you run your institution, how you prepare your institution, and whether you're sort of thinking about a broad horizon financially when you're determining the strategic focus of your institution. And just to put a little present value on what I'm talking about, you know, it's interesting. I wonder right now if we're in a period of prosperity or in a markup and a march up to the next financial crisis. I mean, there is an enormous number of signs today that look much like the signs and markings that led up to the Great Depression. There is a flood of liquidity right now, and part of it is created by government spending. I mean, when you look at what has happened over the last 15 months with COVID and the financial crisis that we've had because of COVID, it is really startling. 24% of the dollars in circulation in the country today were created in the last year. Well, how does that happen? The Fed's balance sheet now has gone up to $8 trillion. Now, just to give you some perspective, before the financial crisis in 2008, the Fed had $800 billion of assets on its balance sheet, $800 billion. Today, that number's about $8 trillion, right? So that is just an enormous change. And of that $8 trillion, the Fed is in the last year bought 56% of all the Treasury issuances, right? So you take all those numbers together and you see a few things. Number one, the tremendous amount of liquidity created by government spending. And we haven't even gotten to the $6 trillion spent for COVID, the $2 trillion marked for infrastructure, money that we're going to spend that neither we, our children, nor our grandchildren are going to have. So there's a tremendous amount of liquidity and credit being created that has to find its way throughout the economy. And so there's an enormous number of things happening at this point that look a little bit like the 1920s. I mean, 1920s followed interestingly enough, the Spanish flu. Spanish flu was 1918 to 1920. We then went into the roaring 20s, only to have a collapse in 1929 that many people blame the Fed for, in part because the Federal Reserve, which had been established in 1913, kept interest rates low to help out the central banks in Europe, particularly England, Germany, and France. And for 2 years, the Federal Reserve Bank of New York kept interest rates in this country low, which arguably allowed the stock market to become even more inflamed and encourage more speculation as there was more cash around over that 2-year period, resulting in what many economists call a much larger crash than we otherwise needed. And so, there's the combination of that, all of this money chasing assets, which is causing a rise in asset prices. And we can see it in the residential real estate markets. There's some markets throughout this country that are just absolutely nuts in terms of the way prices are increasing. We see increasing leverage throughout the country. And lastly, there's a factor that didn't exist in the 1920s, and that is the impact of the internet, cybersecurity, and the malicious use of technology, which we're going to get to in a minute. So the question that sort of is, I think, most pressing for us in terms of identifying the causes of financial crisis is why we have so many of them. And while we're living through them, we may not think that we're leading the world in financial crisis, but we actually are. In the last 200 years, we've had 10, which is more than any country in the world except Argentina. And so if we're comparing ourselves to Argentina, I don't think it's a great thing to be doing, economically or otherwise. But the fact is that only Argentina has had more financial crisis than we have. And that comes from research done by Charlie Calaramas, who's the chief economist at the OCC, and Steve Haber, who together wrote a book about financial panics and financial crisis from an economic point of view. So again, I come back to the question I asked myself: what's the cause of all these financial crises? Why are they happening again and again? And I couldn't get out of my mind the fact that the United States government, the Congress, had such a role in creating the dynamics that caused the savings and loan crisis. And again, of course, there was a cover story, and the cover story that everybody was engaged in fraud, negligence, and criminal activity. But that was far, far, far from the truth. You can't find a report after the fact that talks about the actions of executives and institutions that identifies fraud, criminality, and negligence as anything more than a partial factor in the collapse of the savings and loan crisis. But when you go back and you look at the dynamics in terms of what happened with government regulation, you can identify that as a central factor in what happened to the savings and loan. Because in 1982, when I was at the Federal Home Loan Bank Board, the average savings and loan was paying 5.5. I'm sorry, after the Depository Institutions Deregulation and Monetary Control Act was put in place, and then established the DIDC and deregulated interest rates. In 1982, the average thrift was paying about 12% for its money and earning about 7.5% on 30-year fixed-rate mortgages. Well, that doesn't work. You can't even make up that negative spread on the volume, right? And so you have to sort of come to the conclusion, I think, if you look at this fairly, that government intervention in the marketplace for a well-intentioned reason to help home ownership, to help homeowners get mortgages at a cheaper rate, a fabulous goal. But by doing that and intervening in the market, what happened is the government and then the states also piled on with usury restrictions, actually created an economic vice for institutions when interest rates went far beyond 6 and 7% where they were when those laws were written, and hit a peak of 21%. So what happened is we created a strategy for financial institutions to house Americans in a market that changed 15 years later to the detriment of the people who were making those 30-year fixed rate mortgages. So the question I ask myself is, this happened other times in history? I mean, you can't see that set of events without asking yourself whether it may have happened again. And that's when I started thinking about writing the book from the perspective of the last 200 years. And as I began my research on the part of those 200 years that I was not alive for, one of my friends said, well, you're lucky that you're over 100 years old, because that way you've seen most of the 200 years yourself. But for the periods that I was not around for before 1975, I did an extensive amount of research. And the conclusions I came to were, in every one of those 10 financial crises, 1819, 1837, 1853, 1873, 1893, 1907, 1929, 1989, 2008, every single one of them, the government had a hand in doing something that set up a mechanism that started the dominoes falling or facilitated the actions of companies that created the crisis. Now, that's not to say that there hasn't been corporate abuse, that there hasn't been speculation, and that there hasn't been illegal and unfortunate and inappropriate activities taken by the private sector. There have. But the fact of the matter is the government is also not blameless. But if you pick up any book about financial crisis, what you typically read about is the robber barons, the corporate executives, the bankers who are responsible for financial crisis. Most of the books coming out of 2008 are replete with that. There are some books, however, and this is what I sort of started to focus on, that try to call out the government on things that it has done that has caused the crisis. And so 1837, President Andrew Jackson, was a one-man wrecking crew economically in this country. He eliminated the Bank of the United States just before the financial crisis was brewing. He moved all of the money of the Bank of the United States from the East Coast to the West Coast, causing a sort of knee-jerk reallocation of capital throughout the country. He forced all the sale of federal lands in the country. And remember now, this is a country that is expanding from east to west. He forced all those sales of federal land by the United States government to be in gold, thereby undercutting all of the paper currency that was then in circulation and creating what I call currency confusion, leading up to the collapse of 1837. Another good example, of course, is in 1907, when, because of a lot of speculation, because of new financial instruments in the marketplace, and the interesting thing is there's always a new financial product, there's always a new financial instrument, and there's always a new financial backdrop that leads up to every crisis. It's as if there's an automatic dislocation of the norm, and that causes a realignment of competitive activities and causes the dynamics that create a crisis. But in 1907, the interesting thing about that crisis is that the government actually added to the crisis by its actions, and then basically stood by not knowing what to do, leading J. Pierpont Morgan take control of the U.S. economy and begin bailouts and begin to take the leadership role to try to solve the problems that were happening and stabilizing the U.S. economy. 1929, we talked about that a little bit. In the 1920s, beginning in 26, 27, 28, Federal Reserve Board did not raise interest rates to stop speculation in the marketplace and reduce the amount of credit available, because the Benjamin Strong, who ran the Federal Reserve Bank of New York, was asked by his friends at the central banks in England, Germany, and France to leave interest rates low here so as not to cause a crisis in those European countries. And by doing that, the crisis in this country was extended and over-exaggerated, because that was 2 more years of speculation in the stock market that occurred that caused a bigger crash that might otherwise have been necessarily required. And so you see it over and over and over again. And lastly, in 2008, The story about 2008 we all lived with, and everybody knows their sort of slice of that problem. But there's an interesting book that was written by Joe Nocera and Bethany McLean called All the Devils Are Here. And I was reading that book, and I got to page 16 or 17, and I started to laugh because the story was about something I had done in 1987, which they contended was a turning point in the events that caused the 2008 crisis. And what that was is I was representing 5 investment banks in New York petitioning Secretary of HUD Pierce to stop Fannie and Freddie from getting into the REMIC business. And we filed a 100-page brief with Secretary Pierce, telling him that if he let Fannie and Freddie into the REMIC business, they would dominate the business to the disadvantage of the street, Wall Street, and the private sector. And what happened there was Secretary Pierce allowed a $6 billion pilot program, which of course was the camel's nose under the tent, because 2 years later, it became an unlimited program after the government decided it was worthwhile. And that, of course, put Fannie and Freddie on a trajectory to where it ultimately exploded in 2008 in that great mortgage-backed subprime mortgage-backed securities explosion. And Bethany McLean and Joe Nocera believe that that was a seminal point, that if Secretary Pierce had actually stopped Fannie and Freddie from getting into that business, it may have made a difference. But the fact of the matter is, when you go back and you look, both Presidents Clinton and Bush, beginning in 1995, decided that we needed once again to raise home ownership in this country. And they decided we need 8 million more homes being bought in this country. And therefore, they enacted policies, and the bank regulators enacted policies to get that done, right? And of course, when that's happening, everybody thinks it's great because the home builders are building 8 million more homes. The people who make washing machines are selling 8 million more washing machines. The people who make carpeting are selling that much more carpeting. And so it energizes the economy when those kinds of things happen. But the problem was, of course, 2 things. Number one, Wall Street was delighted to have 8 million more mortgages to securitize. But the problem was, where do you think those mortgages came from? When the administration of both the Clinton and the Bush administrations decided that they wanted to increase home ownership, which again is a terrific thing, right? It's a great goal because it has more people investing in the American dream. What could be better? The problem is that when you enlarge the scope of mortgage borrowers, they weren't enlarging the scope at the top end of the ladder. Financial institutions, which had lots of capital and cash at the time, needed to expand the scope at the bottom of the credit ladder. And of course, we all know what happened in 2008. All those subprime mortgages were made. They were made in ways trying to get people into homes that created a panoply of different kinds of mortgages, which all kinds of bells and whistles, and had no doc loans and all kinds of loans, all of which we're very aware of, leading up to an explosion in 2008. But the interesting thing about that is that most economists would tell you that there weren't enough subprime mortgages in the country to cause the subprime mortgage crisis of 2008. What happened was the subprime mortgages and the mortgage-backed securities built from them were the trigger that exploded all of the other financial IEDs that are in the marketplace. And so that at the end of the day, what it was the collapse of confidence. It was the collapse of confidence in every financial asset that every financial institution had on its books, thanks to what AIG did, thanks to what a number of financial institutions did in basically creating these mortgage-backed securities, which really had very little credibility behind them. And so you can see here it's a complicated set of factors that go into all these financial crises, but we are never going to solve the problem of future financial crises. And I know for a fact that we are sitting here today creating the next financial crisis. How do I know that? I know that because over the last 200 years, we have always been creating the next financial crisis. It is always coming, and it seems over the last 80 years that they're getting more and more serious and severe each time. And I think, as I explained in the book, I think there are a lot of reasons for that, including the global intercomplexity of the financial services system that we have. But we are sitting here today creating the next financial crisis. And I think if I were running a financial institution, if I were on the board of directors, I would say to myself, let's think about that strategically. So maybe we are here creating the next financial crisis. Maybe the government is creating too much liquidity and too much cash and doing too much intervention in the financial services business that is going to end up in some sort of financial crisis as markets move in one direction or there's some national disaster or something like that. Where do I want to be positioned? What do I want to be doing? And so I came to the conclusion that unless we are willing to admit that the government has been a player in the creation of financial crisis, something you would obviously hear the government denied if the government's the United States Congress or whoever it may be, but clearly they have been a player in the creation of financial crisis. Now, in that sphere of what I call the government, I don't include the regulators. And the reason I don't include the regulators is because I think they've been given, I think they're the most talented people on the face of the planet in terms of financial regulation. I think nobody knows how to evaluate credits and debits better than them. I think they understand risk management better than any supervisors I've seen around the world. The problem is the Congress is sending them down the wrong paths to regulate. And if you look at all the statutes that have been written over the last 50 years, it seems to me we're regulating the wrong things in the wrong way at the wrong times. Let me give you an example of what I'm talking about. When I started at the control of the currency in 1976, there were about 200 pages of OCC regulations for national banks. Of that, about 125 pages were about establishing a national bank and what investment securities a national bank could invest in. So there were really about 75 pages of substantive regulations issued by the Office of the Control of the Currency. It was a principle-based approach to regulation, not a rules-based approach to regulation. Joe Selby, Paul Holman, who were the titans of financial supervision at that point at the OCC, I remember them telling me, in a meeting where we were going in, I think it was a meeting after the failure of Franklin National Bank, which was the largest failure at that time in the country. And I asked some questions as a young lawyer about why the financial statement still showed some net worth of those companies. And Paul Holman looked at me and said, kid, a bank's insolvent when I say it's insolvent. And what he meant by that is there's an art to figuring out the value of the assets on a financial institution. And they were very much ingrained in a principle-based approach to regulation. Now, that principle-based approach is long since gone. Our regulators are not allowed to use their discretion. And some would argue that's good. Some would argue that's bad. I think it's bad. I would rather have a regulatory system where we paid our regulators what the market price was, so we had the best talent all the time, and we gave them the discretion, unfettered by Congress and others, to do their job the way they think that job should be done, because they're the experts, right? And so what I think's happened is we've effectively turned supervision on its head. And what do I mean by that? So if you look at the triad or the trinity of three different things that regulatory supervision does, I would say that the most time and the most effort of a regulatory system, for which we're paying dearly, the most time should be directed at trying to evaluate the factors that are creating the next financial crisis and being prepared for the next financial crisis to make it as soft or as light as it possibly can be, right? That seems to me to be the highest and best use of financial regulation. The second tier of regulation should be creating capital buffers, liquidity buffers, and sort of an outside umbrella of things that guide the financial instincts of the people who are running those financial institutions. Because at the end of the day, The more regulations and the more rules that are written, the more the regulators and the more the Congress of the United States are running financial institutions. Of course, everybody would say, no, 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 they're not. But the power of the veto, which regulators have, of course, is a very powerful veto and goes a long way to running a financial institution. And I can tell you, I don't think there's any congressman, senator, and I don't think there's any regulator, since I one was, who believes they know how to run a bank. On the other hand, though, all of this rules-based approach to regulation is causing them to be in the position of running the bank. So let me come back to the OCC rules and regulations. Today, there are over 1,200 pages of regulations from the OCC, 1,200 pages, as opposed to the 200 pages in 1976. Now, does that mean we're 600% safer, or we're 600% more rules-based? And at the end of the day, I believe that a rules-based system is really not a great system, because every rule has a loophole. Every rule creates an argument, and every rule needs lawyers to interpret it. Now, I think a principle-based system is a much more efficient and better system if you have the right laws and the right people making those decisions. So the last tier of financial regulation should be micromanaging institutions. Who are the institutions that should be micromanaged by the financial regulators? Well, it's the institutions that are in trouble, the institutions that can't seem to do it themselves, the institutions that have low capital, aren't making any money, have management problems. Those are the institutions that should be micromanaged. And if you think about it, particularly since the savings and loan crisis, this pyramid has been turned on its head. And now regulators spend the most time micromanaging institutions, the next amount of time creating capital liquidity buffers and things like that. And then thirdly, spending the least amount of time worrying about the next financial crisis and trying to be prepared for it. The fact of the matter is, in the last 200 years, we have not predicted, nor have we ever been prepared for a financial crisis. And given the amount of money that we're paying for the best system in the world, I'm hearing some feedback. I'm not sure what that is, but I think someone needs to be on mute. So I think that we've sort of turned the system upside down on its head, and we ought to get back to trying to be prepared for an ameliorating future crisis, which is where the most amount of money is lost and the most amount of pain is extracted from everybody, including the Main Street as opposed to Wall Street. So at the end of the day, what I came up with was a list of what I thought were the major causes of financial crises in America. And I'll tell you what they are very briefly. Number one is what I called managed economies. And that is the Congress and regulators, particularly the Fed, taking an active role in managing financial services, managing the economy, and making mistakes. Number two is overheated markets. That's sort of the economic primary factor that everybody cites to when they're talking about financial crisis: overheated markets, assets being mispriced, risk being mispriced, too much cash, too much liquidity, looking to invest in something. And of course, the problem is that in an overheated economy, everybody's in that roller coaster going up, right? And you know, and I know, when everybody's going up in that roller coaster, it's great. Right? Everybody's happy, everybody's excited, everybody wants to make money. And then you hit the peak and you go down. And the problem is, in economic circumstances, nobody knows where that peak is and when the world's going to change, and that coaster is going to drop precipitously, and you're going to be in it. Third factor in financial crisis is psychology. There are enormous psychological factors that go into people's investment strategies when things are good, and their strategies when things turn around. And so there are actually chemical reactions in human beings which make them invest when times are good and make them pull back when times are bad. And so what you have is, just from a human point of view, everybody moving in the same direction at the same time based on what they perceive to be the ride up that coaster or the ride down that coaster. The fourth factor that I found as having an impact on financial crisis, and this is, in my estimation, the largest factor in terms of creating financial crises, is confidence. Confidence is the one thing that makes an economy work, and the lack of it is the one thing that makes it fall apart. And the funny thing is about all of these crises and about looking at economic curves and ups and downs is you never know what the trigger point is that will cause that loss of prices. In the last financial crisis, it was the loss of value in subprime mortgages. But that then exploded and caught fire and impacted a lot of other financial factors and a lot of other financial weaknesses in the economy to cause a global shutdown, in effect, a global recession, if not close to a depression. Now, again, there weren't really enough subprime mortgages on the planet to do that. What happened was that was the trigger that caused the loss of confidence so that almost no financial asset for some period of time could be sold because it had no verifiable asset value. Number five, the fifth factor that I think plays into this is market fermentation. When I've seen this as a regulator, you write a regulation in 1985 and events change, and the regulation by 1992 is actually counterproductive. And so there needs to be a refreshing of the view of regulation from time to time, instead of allowing the same structure to be there all the time and playing itself out and becoming eventually obsolete. The sixth factor is unanticipated events. The Great Fire in Chicago, the Great Earthquake in San Francisco, all of those have had impacts on financial crisis. Whether or not things like global warming in the future will have an impact is yet to be known. But unanticipated events always play some role in a good number of these financial crises. And so if we're going to solve the problem of future financial crisis, we have to solve all of these problems. Now, let me say a few words about technology, because 1/3 of the book is about technology, about where it's going, how it can be used. And let me shorthand what is about 100 pages, a little bit more than that in the book, and basically say technology, in my view, is a two-edged sword. Technology can provide the greatest innovations to improve the quality of our financial lives than almost anything that has ever occurred up until this point in time. Just think about it. Technology can help financial institutions better serve their customers, make better investments, better evaluate their future, better evaluate their retirement options. Artificial intelligence, for example, deployed liberally throughout financial services, will make an enormous difference in the quality of our investment lives and our economic lives. It will also make a difference in the ability of financial institutions to run themselves. Better risk management, better investments by the institution, better knowledge about the future, more predictability about the future. So technology is an enormous asset, enormous technological factor that could create a better quality of financial life for all of us. But at the same time, it is also an enormous threat. You know, there's documentary out on Netflix about Madame Curie. And the one thing you cannot escape from watching that, and I've read a few books also related to it, is that the person who created radiation that led to the creation of the X-ray machine, which is one of the greatest developments in the history of mankind, also led to the development of the atomic bomb. And so you see this dichotomy with all of technology. It can be used for fabulous good, and it can be used for fabulously bad things. And at the same time, technology is our greatest threat out there, right? We have no early defense system in cyberspace. We have no cyber coast guard. We are seeing solar winds, the Colonial Pipeline, the meatpacking hacking. We are seeing how technology can be used against us again and again and again. And that is only going to continue as technology gets cheaper and into the hands of rogue nations, fanatics, terrorists, and others like that. And so we really have to be careful about how technology plays out, and we have to consider it in its dual role. Let me give you one example of how technology threatens the future of financial services. And this is a very simple one and primordial one. We now have digital signatures and encryption protecting everything that we do online, right? And we all know that digital signatures and encryption and hashing can be broken because it's all a matter of mathematics, right? It's all a matter of numbers. Now, sometimes the easiest way to break it is, let's just look at an example. Today, normal R encryption, 48-bit, 2048. That's right? A brute force attack. To do a brute force attack against that R encryption today, with today's technology, take 300 trillion years to do that brute force and break that encryption. Fast forward the next 10 years, 20 years, whenever we have quantum computers, and quantum computers are coming, and they operate on a different system than zeros and ones, and they are photon based rather than zeros and ones based and digitally based. And so when we get to quantum computing, which China tells us it will be dominant in 2030, as it tells us it will be dominant in artificial intelligence in 2030, when we get there and we have quantum computing, a reasonably powerful quantum computer can break 2048-bit encryption in 30 seconds. Not 300 trillion years, 30 seconds. So what does that say about all the security that we've got in place today? That security is meaningless if the wrong people, if the bad guys get quantum computing first. And so that's what we're dealing with in terms of technology. So we really have to have a dual-edged kind of sword approach to technology. Yes, it's great. We have to figure out how to use it, but we shouldn't be doing it just because we can do it without knowing that we're going to be secure in putting every inch of data and every ounce of financial worth on a system, a network, a server, or a cyberspace that isn't guaranteed to be secure. And right now we know it's not guaranteed to be secure. And frankly, security experts will tell us that we're creating threats larger than we're creating, faster than we're creating the solutions. So that, I think, again, is another serious problem that we have to think about. So let me just finish here by talking about what I think are the solutions to some of these problems. And I'll only be brief because I want to leave some time for questions. One, smarter regulation. That includes technology. Two, less politics in our regulation. And there are ways to do that. Look at the way that the Joint Tax Committee creates a bipartisan committee with professionals advising that committee. That's something perhaps we can do with financial services. Three, we need to cost benefit everything we do in the financial services business. The fact that there was no cost benefit analysis done before Dodd-Frank was enacted, while it was being enacted, or since it was enacted, I think is not the best way to run the largest economy in the United States, in the world. Fourthly, we have to revise the way we're doing financial regulation and reverse that pyramid back and be most focused on the next financial crisis, predicting it and trying to reduce the impact of it. That includes a number of other things that I've talked about in the book, and one of them is real-time regulation. And I'm not going to take time to do that now, but I think that if we can get to a point where we can focus on regulation on a real-time basis as opposed to constantly looking backwards, constantly looking at where an institution's been, that will help us get to a much better place in terms of financial regulation. And lastly, we're going to have to deal with the technology threats in a serious way. We simply don't have today the processes, the procedures, or the defenses in place to deter, to track, or stop the kinds of attacks that are happening. And most of the focus that we have today is on rebuilding after it does happen. FS ISAC, Sheltered Harbor, all of those things that the financial services business has put together, which are terrific, are focused on regrouping after the attack occurs. And I find it interesting that when you sort of look at that, if the U.S. military, its defense was built around not being able to defend, but simply rebuilding afterwards and sending the Army Corps of Engineers in, that would be a very interesting, I think, approach to defense. One in where we shouldn't have when it comes to cyberspace and the internet. So let me stop there and take whatever questions you have. I'd be happy to answer any questions that come up.
Okay, Tom, thanks for that very informative session. We do have a few questions. I just want to start off with one of my own. You had talked about the next economic financial crisis, and you were kind of talked about and referred back to the Spanish flu period in 1918 and how that was preceded 11 years later with the Great Depression. And you had mentioned potentially a Great Depression is in the cards for us in the future. Are you thinking that's kind of 10 years out, or do you think it could come upon us in the near term? What are your thoughts about that?
Well, that's an interesting question today. I don't know if you saw in the Wall Street Journal with the way consumer price index ratcheted up, I think 5%, which of course is a forebearer of inflation. And we've all been wondering how we could flood the economy with all of this cash over the last 10 years, starting with the 2008 crisis, and not have some ramifications. And I think we have not had ramifications is because the Fed has taken a control of the economy, which on one end of the spectrum is good and on the other end of the spectrum is bad. But when you look at the factors that were extant at the time of the Great Depression, leading up from the Spanish flu pandemic in 1918, the facts and circumstances are pretty similar. And interestingly enough, one of the ones that caught my attention just in the last 2 weeks, in terms of adding on to the factors that were existing in the 1920s and today, was part of the element in the marketplace that led to the collapse of the stock market was a run-up in copper prices in the 1920s, and then a scandal that erupted around copper prices. And interestingly enough, copper prices are now running up in this country, largely because of the hopes that copper is going to be a very valuable element in the spending that will be done for infrastructure over the next several years. So if you lay out the elements of the Great Depression against what we have today, a market that seems to be on fire, assets building value and perhaps being overpriced, leverage being increased, an enormous amount of cash and liquidity being thrown into the economy by the government, interest rates being held low, right? Interest rates being held extremely low by the Fed. All of those factors, including the run-up of copper prices, all of those factors have the same, in effect, bearing as they did in the 1920s as they do today. And the one other factor that I saw in the Wall Street Journal several weeks ago that is similar is that we're now approaching, I think we have the highest level of retail investment in the stock market that we've ever had. In other words, mom and pop investors, individual investors in the stock market. And that was the same thing that happened in the 1920s. In the 1920s, the stock market became a popular investment for everyone. Moms, pops, small businesses, not just institutional investors. We've got the same thing happening once again. And so, yeah, there are a lot of similarities. Can I predict a Great Depression, another Great Depression in 2029? I can't, and I don't think anybody can, because nobody has ever predicted any of this stuff because there's so many complex factors. But all I can say is, I would suggest that the regulators start using technology and artificial intelligence to run predictive scenarios and base it on big data that they've collected over the last 100 years, analyzed with algorithms, and try to see predictive scenarios going out in the future. And if they did that, I think we'd have a better chance of offsetting those crises from happening and probably preventing them in some respects.
All right, thanks, Tom. We have another question talking about the United States had 10 financial panics in the last 2 centuries. Is that a high number for any one country? Are we leading in that metric?
Yeah, as I suggested, it is high. In fact, it's second worst in the world. And we can keep developing these financial crises over and over again at a pace that far exceeds, for example, Canada, our neighbor. In this period of time, Canada has had 2. We had 10. What's the difference? I mean, Canada's only got 6 large banks, really. And so there's an enormous difference in the number of financial crises that we're having. Some of that, of course, I think is related to the issue of, number one, we're the most complex, largest economy in the world, and it's interrelated to so many different factors. But, you know, in Europe and other places around the world, I'm not so sure that they are as quick as we are to pull the trigger in financial crisis times. And what I mean by that is they are big believers in forbearance. In this country, regulators in Congress used to be big believers in forbearance up until the savings and loan crisis. That shifted. And now forbearance is viewed as something very bad. And so I think that what has happened is we've lost our patience in this country. And we look at numbers, and when we see a number, well, you only have 3% capital, we've got to take you out of the marketplace. And without looking at the dynamics of the marketplace and saying, well, wait a minute, is this a temporary blip that'll be corrected in the next 24 months? I mean, what we did in the COVID crisis and what we're doing right now is using forbearance, right? We're forbearing on borrowers. The regulators are forbearing on the financial institution because we are dealing with a temporary situation. There's no reason to mark down assets and take out institutions when we know this is an aberration and we know it will pass. And so there's a give and take there between solid regulation and forbearance. And I think we've lost our balance in that regard to some degree. And that may be playing out in terms of having more financial crisis. But I go back to what the president said in 1913 when the Fed was enacted, and then many congressmen and senators said, you can see speech after speech basically lauding the conclusion that because of the creation of the Federal Reserve, we would never again after 1913 have a financial crisis in this country.
Okay, thank you, Tom. We're actually running out of time. It's right 12 noon right now. I want to thank you, Tom. This was a great session. Really appreciate it. Very enlightening to me, and topics that I'm really interested in. I'm sure our members were too. I just want to remind everyone, like Adam had mentioned, our next webinar is June 24th. That's going to be conducted by our financial economist, Brian Jones. The topic is taking stock of the current economic expansion, and we'll be sending out that invite next week. And then we're going to take a hiatus from sessions over the summer after that. So everyone, thank you for attending. Really appreciate it. And don't forget to, in the survey, please note whether you'd like to take advantage of the option of getting a complimentary book of Tom's. So again, Tom, thank you. It's really been a pleasure, and have a great day, everyone.
Great. Thanks, Tom.